Over the last 3 months, we've seen a major sell-off in interest rate sensitive areas of the market. Some of these securities have fallen between 15 and 40%. Now, the genesis of that sell-off has been rising interest rates in the United States and a view that they're going to go higher. And it's been particularly amplified by Trump becoming president-elect and the fiscal stimulus program, which he's heralding. We've got a couple of issues with this. Number one, 3 months ago, the complete consensus, high conviction consensus was rates were going lower forever and going to go to zero. And now we've seen a complete reversal of that view. There's a huge amount of conviction about interest rates going higher without an actually analysis of the background for those rates going higher. In particular, whether fiscal stimulus can actually even occur in the United States. We'll make a few comments. First of all, the securities have corrected significantly. And second, we're being told by a number of strategists now that it's a good time to sell. That would have been great advice 3 months ago. It's probably poor advice now. We're seeing these securities yield 6-7% plus and with growth of 3 to 4% over the medium to long term. So the point here is we can get a 10 to 11% total return from some of these real estate companies and infrastructure securities. A 6-7% yield plus 3 or 4% growth. So what we do to work out whether or not that's a fair price or not, we take away the equity risk premium from that total return of 10-11%. Now, the return over bonds that you'd expect from a Sydney Airport or a Transurban or a Goodman Group or a Westfield is about 3 or 4%. So if I've got a total return of 10%, keeping the numbers simple, we'll take off 4%. That means the risk-free rate that's being priced into these securities is 6%. Now, bonds are at 2.5%. They're nowhere near 6% now. So what we're saying is the bond correction has been priced into these securities more than justified, and they're probably a good opportunity to buy. The reality is cash rates are extremely low in Australia, and if you haven't got real estate or infrastructure securities in your portfolios, now's possibly a good time when sentiment's very, very negative towards them. There's been a lot of selling, and volatility should be exploited and not be feared. And take a 3 to 4 year view. We think the total return of 10-11% from some of these names is an excellent return given the risks involved. So post the correction we've seen in interest rate sensitive securities, which has been quite vicious and material. We're looking at companies such as Macquarie Atlas, which owns a major toll road network in France. It's an integral part of the French economy. And you look at the 15-year experience of that toll road, it's increased its earnings by 4% per annum for 15 years. All through the GFC, it increased its earnings. So it's a highly defensive income stream. Not only that, it has a good yield at the moment, but the yield's going higher. At the moment, the company distributes 20 cents on a share price a bit above $4. That's going to double over the next 3 years as they reset their interest rates to lower levels. They're paying a very high rate of interest right now. That's going to get reset over the next couple of years, and the dividend will probably move to 40 or even 50 cents. So on a $4.30 share price, it's obviously a very, very high dividend yield, and it should continue to grow on inflation post that. So we think an excellent investment over the medium to long term. You've just got to see through the volatility. Don't expect a positive outcome the next few months, but take a genuine 3 to 5 year view, and we think you'll be rewarded.